has had a strong run year to date. I think this is the first time we see a bull market in China after 2009. I don't think we are in a bubble stage yet because China market had been in a very depressed valuation in the last few years. And so when the corporates have strong earnings recovery this year, we are seeing a market re-rating as well. And I think this is more a normalization of valuation back to a more reasonable level. Previously, China market was trading at single-digit PE, which was very, very cheap in regional or global context. But with the earnings recovery, we are seeing the valuation coming back to a more reasonable level, which is now comparable to other regional markets. Internet, technology, and other service industries like education fall into my definition of new economy. Basically, they are emerging industries that are growing very fast and are not that sensitive to the economic upheavals. New economy is no longer a small part of the economy, it's becoming a big representation of China. We have seen quite a number of upstream industries that are seeing big improvement in profitability because of the supply discipline. For example, steel, cement, coal, and packaging paper are benefiting big time because of this supply side reform. Basically, it's a continuation of the policies that were set out by President Xi. They emphasize quality of growth instead of quantity of growth. So China will no longer chase growth blindly. We should not pay too much attention on the GDP growth because it's not the number that counts, it's the quality that counts. We look at growth at a reasonable price. We always look for mispricing in stocks because at the end of the day, stocks react to expectation mismatch. If our earnings forecast is different from the market, that's where we see potential mispricing opportunities. You have to be more realistic in paying for the high growth names because of the market re-rating. Previously, growth stocks traded at a lower P multiples and now they have been re-rated a lot. But does it mean that they are no longer good investments? Not necessarily. You just have to live with a higher PE multiples because they become well-known stories. We are overweight consumer discretionary in general because we see quite resilient consumer demand in China despite the slow growth in the last few years. And we are seeing consumer upgrade that continues to be in place in China. And this is positive to brands and consumption plays. So this is why we are overweight in consumer discretionary. Apart from consumer discretionary, of course, we are positive on IT. Unfortunately, we cannot have enough in internet stocks because Tencent and Alibaba are over 10% in the index, but the fund cannot invest in more than 10% on a single name. So we tend to make this up by investing in other technology stocks like AAC Technology and Sunny Optical. They are the handset components manufacturers which are benefiting from the smartphone upgrade and also the new technology like the 3D sensing, AI, technology development. We also overweight Chinese properties. This sector is cheap with high dividend yield. We think Chinese properties also benefit from the supply side reform because the government has implemented tightening policies in the property sector, which is actually to the benefit of the big players. Smaller players are being squeezed out because of the lack of access to funding, but the large players can continue to get funding from the banks. So basically, the large players are taking market share away from the small players. And we think re-rating in this sector should continue over time. We also like education. Education is another sector that we overweight in the portfolio. Parents in China keep on investing in their children's education no matter what. China market has caught up year to date, so valuation is no longer at a big discount to the regional markets. In fact, I would say it's now probably at par to the regional markets. Most people still think the recovery is cyclical driven, but I think it's more structurally driven. And if it is structurally driven, I don't think the earnings improvement will only last for 1 year. And what that means is the market re-rating will be a multi-year exercise.